Good afternoon. My name is Jim Shallak, and on behalf of NAFA and the NAFA National Member Benefits Committee, I would like to welcome you to whole life as an asset class compared to real property. At this time, please silence your cell phones and other electronic devices for the duration of the presentation. Now it is my great pleasure to introduce our presenter and my friend, John W. Wheeler, Jr., Executive Vice President of Water Tower Financial Partners, LLC. John supports his agency through seminars, advanced joint sales work, recruiting, and the development of its financial planning endeavor. He is on the faculty of the College for Financial Planning, has taught various certification programs, and is one of only 3 people in the United States who teaches the full CFP curriculum. Please welcome John Wheeler.
Good morning. You say good morning until you get caught up. And I'm never caught up, so I always say good morning. Well, thank you all for coming. Hopefully you're one of the 2 types of people that comes to breakout sessions like this. You know, the first type is the kind that maybe wants to find out maybe a new idea or a new phrase that they can take out and use effectively with their clients. The other type come to throw things. So hopefully we've got more of the first one. All right, you're close enough, and I know what your arm's like, so I'm not afraid. All right, how many people in here believe in life insurance? How many people in here sell life insurance? Hopefully before I'm done, I'll convince you not to do that anymore. Because I believe in selling what life insurance does, not what it is. If you want to clear out a cocktail party, the best way I've ever found is to say, I sell life insurance. So what we're going to do is we're going to take things in a little bit of a different twist. Because as Americans, the one thing that we always hold dear is the value of real property. Fair enough? And that's something that's pretty well universal across the U.S. It doesn't matter whether you're in an urban area or whether you're in a rural area. Because even though I live in Chicago now, I haven't always been a city slicker. I grew up in the town of 52 in the southern part of the state, county population 5,000, and that's where I started in the business. So I've kind of lived on both ends of the spectrum. Now I look out my window at the Sears Tower, which I still call the Sears Tower. I'm still old-fashioned. Willis, be gone, Sears Tower, right? So at any rate, we've played in both ends of the world, and real property is something that everybody still has an appreciation for. So instead of talking about life insurance and all the wonderful things that it does, because life insurance to me is still the 8th wonder of the world. You know, when everybody else comes to the wake with their sympathy and with their prayers, we're the only ones that not only don't have a bill, but we bring financial solutions as well. So I think with the ability to create money like we do something that no one else does outside of the clergy. So I think that it personally is a calling. So we'll often start a conversation like this. Do you own real estate? Well, anytime you ask a question, you know, we're supposed to know what the possible answers are, right? Well, there should be one of 2 answers. Well, first of all, if the answer is no, is it in your future plans? If the answer is yes, are you sorry you bought it? Because if you hadn't noticed, there had been a turn down in the real estate values recently. I've got a client who paid $1.6 million for a house up in the northern burbs in late 2008, which he had appraised for $825,000. So is he sorry he bought it? Well, again, you have to have the follow-up. So if you are sorry, the next question is, would you do it again? See, sometimes that's like marriage. All right? Now let's look at it a little closer. Think of all the reasons that you either bought real estate or are thinking about buying real estate. And I'll pause for a minute and then I'll say, now in addition to that, if you knew that the cost was going to increase and you could buy it today, would you do it? So you've got the capacity. You know it's something that you want to do. Now, if you knew for a fact the cost of doing business was going to go up, would you do it today? All right, let's talk about the value of real estate ownership. First of all, if we can get this advancer to work, you own it. The acquisition payments stop at some point in the future, right? Now, there's disadvantages as well, as we know. So let's say that I've got a 30-year mortgage. Now, when do I now own the property? Try not paying your real estate taxes a couple of years and see if you do. But how many people who buy real estate and value real estate think about that? I'm buying something that even when my acquisition costs stop, I still don't own. Because if I don't pay my real estate tax, they're going to come and take it away. In addition to that, if it has any real value, I'm going to pay insurance. I likely have maintenance costs as well. Now, what's the likelihood that any one of those three over a period of time is headed down? So now, not only do you not own it, the cost to keep it after you thought you owned it is going to increase every year. Right? So let's look at another advantage. You feel it's yours. You've got a feeling of safety, security, belonging. You've got roots, and you're not throwing money away on rent. Isn't that one of the real reasons why people like to buy real property? Rent versus own it? And if, in fact, I'm buying additional property, I also have possible rental value as well. Downside, of course, is you could always lose it if you don't pay it, or if the taxes aren't paid. How many payments can you skip before the bank has a conversation with you? Depends, right? Just like when the press interviewed Bob Dole, they said, "What type of underwear do you prefer, boxes or briefs?" He said, "Depends." All right, you're building equity. You can possibly access that equity in the future if you need it. And the downside is the interest is still payable on a loan. I don't know anywhere that interest is necessarily free long term. And the value also could decline even to the point that it's less than what you originally paid for it, as we've recently been reminded. And the accessibility could also be limited as well. See, we used to think there was that ATM slot out on the side of the building. We could just slide a card down the side of it and we could get the equity out anytime we wanted. Well, what about my guy that financed $1.2 million on the $1.6 million? He thought he had some equity until it reappraised at 8.25. Then what? Or what about all the people that had the Banker's Secret software, to where if I pay extra on my mortgage, look at all the interest I'm going to save. Well, if I prepay my mortgage, what guarantee do I have that I can get to it later? What happens if the equity disappears? Another advantage is, of course, the interest, property taxes. Some repairs may be deductible. If I'm buying rental property in addition to that, I might have depreciation deductions. Under Section 121, I've got a capital gains exclusion if it's my primary residence of $250,000 if I'm single, $500,000 married filing joint, that if I'm good enough to get that type of capital gain, every 2 years it's free money. That's an exclusion, right? And it could even be less than 2 years under certain circumstances, and we don't have time today to go into that. I also would get capital gains treatment if it's sold more than a year after the purchase, and even if it's my primary residence, if I exceeded that exclusion, I'd still get capital gains treatment, right? One of the great things about real property. Downside is the only deductions available still are out-of-pocket costs. We don't yet have the 2-line tax form. What did you make? Send it in. We're not quite there yet. However, if I think I'm getting a deduction and then I find out that the standard deduction would have actually been greater than my allowable itemized deductions, especially now for higher income individuals, due to the phase out, I may have had a deduction that was phantom because it's never going to show up on my tax return. I could have had nothing and had the same effect. So now really, what was the tax benefit of those additional expenses? Come on. And again, there's also no tax benefit if rental property is showing a loss of greater than the income. The fixed acquisition cost, if I'm using a fixed mortgage, downside is the rates could decline in the future. What happens if I lock in a 5% interest rate and then all of a sudden the rates go down? There's no absolute guarantee that I can refinance. The purchase price is fixed as long as I'm using a fixed mortgage. Now, if interest rates go up, it didn't matter. Didn't matter what happened with the tax rate. That's one of the advantages of a fixed mortgage. If the property prices go up in the future, I had the foresight to buy it while it was a lower cost. So all that appreciation is going to be mine. On the downside, come on. Cash outlay is normally more than renting, isn't it? Isn't it almost always correct that the cost to buy an asset is more initially than renting? That's no surprise, is it? I mean, aren't most Americans familiar with that? And is it not also true that early years of acquisition of most types of assets along those lines, of a 10, 20, 30-year mortgage, I have very little equity in the early years? Any surprise? And the price actually paid with interest is significantly more than the purchase price. And we'll go into that in a little more detail in a moment. The property prices, as we know, could also decline in the future. Now, another advantage is I've got control what to do with that future value if I can get it. If I have a home equity line of credit, does anyone ask me necessarily if I've been approved for the line of credit what I'm going to use it for? What I'm going to do with it? No. Downside is that accessibility still depends upon the market conditions, what my credit score is like, and so on. So I have to prove to the bank I don't need the money for them to want to give it to me. Isn't that true? Now, is anyone in shock yet? These are all things that we know, but we don't really often think about. So our job as advisors is to help people realize what they already know but normally don't think about. Because then all of a sudden the process of transition, as you'll see in a moment, won't be any shocker. If interest is taken, interest is still interest. Interest only benefits directly the person receiving it. Another advantage is having a mortgage doesn't affect the future appreciation. How much more would my home or my real property appreciate if I had no mortgage than if I had a mortgage? No difference, right? So we have a large part of America that thinks security is not having a mortgage, and they have one of the highest assets in their portfolio making this. Zero. And not only is it making zero, that asset value can go down as well, and the accessibility can now even be more limited. So am I building my financial security on nothing but quicksand? Because remember, I've got those 3 increasing costs to keep it even after I thought I owned it. Another disadvantage, as we said, the equity can disappear altogether or decrease, even to the point of a loss. And if I do have a loss on my private residence, I can't even use that on my taxes. If the loan interest isn't paid, foreclosure can occur. They're not going to go forever. And if a loss occurs again, it can't be used to offset the income if it's primary residence. And I still have liability exposure too. Remember, there's only 2 times you can be sued. When you do something and when you don't. So if someone comes on my property, did it matter whether it was at my invitation or not? If they're injured on my property, am I not legally responsible? Go like this. Right? That doesn't give me a lot of comfort either, so that means now I have to also be cognizant from a liability perspective, because now if I have other things to lose, guess what? A prudent person would want to also cover that potential loss, wouldn't they? All right? Another disadvantage, what happens if I die before I pay all the payments? The banker going to come and say, well, Sherry, John had been making these payments on a regular basis. We're sorry for your loss. Don't worry about it. We'll take care of the rest of it. What do you think? Maybe 2 chances, slim and none, right? Or what happens if I'm disabled before all the payments are made? Likely the same thing. Oh, yeah, we feel sorry for you, and by the way, the payment's due on the first of the month. Right? Now let's compare that with whole life. We've talked about good, bad, and the ugly of real estate. I don't think anyone had any real surprises. We may have mentioned a couple of things we don't often think about, but at the same time, let's look at a comparison. All right, now from an advantage standpoint, you own it. Acquisition costs stop sometime in the future. Is that true of whole life? Absolutely. If it's a limited pay whole life, if it's 10 pay, into 10 years, I couldn't put more money in it if I wanted to. If it's a 20 pay, LP 65, life paid up to 100, whatever, doesn't make any difference. When it's over, it's literally over. And when the payments stop, there's also no further cost to keep it. It really is mine. I acquired an asset with no future cost to keep it. Downside is the acquisition payments may be a longer period of time, not necessarily. But if I'm buying a substantial amount of whole life insurance, I may have premiums payable technically at least until age 100, sometimes maybe even 121. You say, well, I'm not going to make it that long. Well, you don't know that. When I was born, the doctors told my mother she wouldn't live to see me grown. We buried her about 1.5 years ago at age 97. I always just laughed and said I hadn't grown up. That's what was keeping her alive. But the thing of it is, you know, there's over 78,000 Americans today over age 100. The fastest growing segment of the population is 85 and over. George Burns said his goal in life was to live to be age 100 because it had been statistically proven few people die after that age. Another advantage is you've got an asset that's guaranteed to increase in value every year you own it. Now, how many assets can you acquire that you can use the G word with certainty, even in every compliance scenario? I can say that this is guaranteed to increase in equity every year I own it, can I not? I also have additional upside potential in addition to those guarantees in most scenarios, unless it's a non-par whole life. But if it's a participating whole life, interest-sensitive whole life, direct recognition, non-direct recognition, the basics still say that my guaranteed cash value will equal my death benefit at some point, depending on the structure of the contract. Fair enough? See, not everybody understands they have an allergy to red ink until they see it on their statement. But a statement on a whole life contract never has red ink. It gets blacker every year you get it. You're not throwing money away on term, and you don't have to die to have value. See, the actuaries have got it right, and we know that the only perfect actuary is the Sicilian actuary, because they can not only tell you how many people are going to die, they can tell you who and when. But still yet, with term insurance, it's actuarially priced to die before I do. I don't care if you're writing Banner or who you're writing, it makes no difference who the company is. Look at the numbers, add up the cumulative term premiums. And in 99.999% of the time, the cumulative premiums will exceed the death benefit before your normal life expectancy. Downside, don't see any. Another advantage, you're building equity. You can access about 90% of that equity upon request. See, we were the original promise keepers. Ask and ye shall receive. It doesn't matter if you're unemployed. It doesn't matter what your credit score is. It doesn't matter how pitiful your financial situation is. It's your money. Ask and you shall receive. Downside is, of course, interest is still interest. Interest is still payable on the loan. Another advantage is I've got tax-deferred growth, just like I have with my real property. When we go and we talk to our congressman, I said, you know, I don't get a 1099 on real estate if I had an increase in the year. Right? If I own a stock and it does in fact appreciate, do I get a 1099? No, I only get a 1099 if I sell it. So why are we talking about tax and inside buildup? We don't do that with anything else. Possible tax-free withdrawals if it's not a MEC. Also, I've got possible tax-free income if I'm using loans if it's not a MEC, right? And it's income that I can turn on and turn off. I'm not controlled. Another downside is if the tax is as applicable, it's ordinary income. I never get capital gains treatment. But by the same token, let's look at all the other advantages. I've got other tax disadvantages, of course, if it is a modified endowment contract, then on either a loan or a withdrawal basis. But still yet, comparatively, would you rather have certainty of access instead? I mean, it doesn't matter what the benefits is if I can't get to it. It's like giving me a Lamborghini Diablo and no keys. I'm not going anywhere with it. The premiums are normally not tax deductible. Because if Uncle Sam gets it and it goes intas, he gets it and it goes outas. So even though we think sometimes we want everything to be deductible, we really don't if we understand it. You know, there's a reason that everybody's afraid of the IRS. Put the two words together. What's it spell? The IRS. Theirs. Think about it. There's a reason they call it a code. Another advantage of the fixed acquisition costs and the time of payments. The ability to stop payments before that designated period and take a reduced paid-up contract. Now, can I go to my banker and let's say, well, I think I paid for the living room and the bedroom. I'll keep them. You can take the rest of the house. Doesn't work that way. Can I do that with a whole life contract? Can I not, usually very early in the stage of the whole life contract, take a reduced paid-up policy for more than I've paid in premiums? So how's that a bad thing? The cost of acquisition in the future would almost always be more. Why? Every year I get older, the cost of doing business goes up unless I get healthier. Most of us probably aren't going to get healthier. Every time I go see my internist, he says, John, you should be 6'10". I'm still not 6'10". I probably will never be 6'10", and there's things I enjoy probably enough to prevent me from being at the ultimate. Let's be fair. Right? Most of us aren't in total depravity. The purchase price is fixed if it's all whole life, just like a fixed mortgage, right? It doesn't matter what happens. And as the prices go up in the future, the cost is locked at the time of purchase and could never get worse, only get better. Because if I did become 6'10", my rating would probably improve, right? But it can't get worse. Another downside is the cash outlay is almost more always in the early years than term. Why? Isn't it always more costly from a pricing standpoint to acquire an asset than a liability? Because if I buy term insurance, unless I cooperate and die, and the sooner the better for the rate of return, I'm probably going to end up never getting anything from it. That's why LIMRA statistics say 93% of all term policies never pay a death benefit. The early years have little flexibility due to little or no equity. Another advantage, I've got control what to do with the value in the future, just like with the real property. If I can get to it, nobody tells me what I have to do with it. The difference is I can get to it for opportunities. I can get to it for emergencies. I can turn it on. I can turn it off. I'm large and in charge. And for those of us who are quasi-control freaks, we like that. Downside, if taken as a loan, interest is still payable. Another advantage is having a loan doesn't affect the future growth in equity. Is my guaranteed cash value increase going to occur whether I have a loan or not? Yes. If I have an interest-sensitive contract, it's still going to have something credited. If it's a participating contract, I'm hopefully going to receive a dividend as well. Right? Doesn't prohibit that. And if the loan interest is not paid, what happens? We just add it onto the loan. And depending upon where I am in the contract, how greedy I've become and how much I'm getting to, because remember, pigs get fat and hogs get slaughtered. So if I don't get greedy and I'm not over-accessing, By the time I'm anywhere in the contract in a few years, the values are growing at a much more rapid rate than what it is. That's why the companies don't allow us to kill ourselves and get 100% normally. That's why it's limited to 90. Another advantage is death occurs before all the payments paid. What happens? Not only do I get the equity that I had, I get a bonus. And what's the tax treatment that we're fighting on the Hill to preserve? That's income tax free. And as we continue to remind our legislators, just because that's not taxable now doesn't mean it's not important to the economy. What do you think happens with that money? The widower, the business person doesn't just put it in a vault somewhere. It goes right back into the economy, helping to create jobs, to keep the kids in school. And most of the money eventually ends up getting taxed somewhere anyway. So it looks like you ought to be encouraging us to sell more instead of doing anything to prohibit it. Additional value above the equitables payable in that form of that tax-free death benefit. And if a loan existed at the time of death, guess what? Is no more. So I'm still going to have a net death benefit payable above that. We all know that, but sometimes I think we take it for granted. If I'm disabled before all the payments are made and the balance is still owed, well, guess what? Unless I had disability waiver of premium, that's no different. Well, so what? All right, now we finally found one thing we may be even on. I think we've already stacked the deck pretty well. Additional values of whole life. Protected against bankruptcy in most states if the spouse is a beneficiary. Has the potential to pay off the loan with interest itself with future dividends if I'm using a par contract. I can apply the dividends to pay off the loan and the low interest going forward. It's not included on the FAFSA form if it's owned by the parent for education funding calculation, and we'll talk about a concept there in a moment. And given the same payment period as a home, the equity typically is going to build faster, and I'll prove that to you. So what if I could show you an asset class that, given a limited amount of guaranteed payments, of a guaranteed amount, that is guaranteed to increase in value every year you own it, that has about 90% of the equity available upon request at any time, that would provide tax-deferred growth, possible tax-free future income, would continue to grow at the same rate even if a part of the equity was being used, that had no further payments due in the event of death occurring before all payments were made, and that could include an option in most cases that would also take care of disability. Well, that maybe be of interest to you. Now, when did I ever use the word life insurance? But who wouldn't want an asset class like that? I mean, pick a hole in it. Find something that you could say, well, that means you don't believe in CDs then. You don't believe in treasuries, the normal thing we usually use to defend it. Well, if I could sell you a piece of real property that was guaranteed to increase in value every year you owned it, that had additional upside potential, that had 90% of the equity available upon request, that could include an option to waive the payments in the event of disability, and oh, by the way, if you have to skip a payment or two along the way, we'll just add that on the loan, don't worry about it. How many of those contracts you want? Would it really matter if I told you it was life insurance? And I'll say that. Because see, now I'm not selling life insurance, I'm selling what it does. So let's take a look. Let's say I've got a $250,000 mortgage. Now, you can put as many zeros to the left of the decimal that you want to. If anything, it just works better. But I wanted the presentation to be at a level that anybody here could relate to, so we kept it low. I've got a 30-year mortgage. Let's say I got a 4.5% fixed rate. That would be $1,266.71 a month payment, principal and interest. I would pay over that 30-year period of time $206,018 in interest, which means my actual cost was not $250, it was $456,018. So I paid almost double what I thought I paid. But it's very much like when you go to Vegas. You only count your winnings, not your losses. They don't keep the lights on by people carrying money out. It's leaving it there. There's a big billboard as I go up toward O'Hare, Grand Victoria Casino. We've got a 94% slot payout, percentage payout. And they're bragging about it. That means they're keeping 6. Right? And people think it's wonderful. Appreciation? Who knows? Continued maintenance, insurance, and property taxes to keep it, that we know, and we also know the likelihood is it's probably going to be going up. Continued liability exposure, even after my mortgage is over as well. Now let's compare just to a 20-pay whole life. Let's say a male, 45, select preferred non-tobacco. We're going to put in the same amount of money that we had for the payment for principal and interest, right? 20-year period instead of a 30. No further cost to keep it after I own it. That would provide me an initial death benefit of $557,638. So I make one payment. I get killed in a car accident. That's worth $537. What type of appreciation would have I had needed for a one-day appreciation from $250,000 to $537? Can't even do that in California, I don't think. $304,010 in total cost. My guaranteed cash value after 30 years is $384,648. See, I can beat you with guarantees. I don't even need the extras when we're playing fair. Oh, and by the way, if we want to look at the illustrative 30-year cash value is $753,350. So what type of appreciation would I need over that period of time for that $250,000 to grow to that? And oh, by the way, when I'm looking at that appreciation, I have to remember I'm still paying to keep it. So it's very much like when I'm talking to business people and I say, if somebody else was paying your overhead, wouldn't your bottom line look better? But we tend to think of, well, we pay this expense over here and it doesn't affect over here. Well, it still does. And oh, by the way, the illustrative death benefit, as the old Blood, Sweat, and Tears song says, and when I die and when I'm gone, there's nothing left to carry on. Well, here we got 1,092,159 reasons why it was a better deal. Come on. Should be on the screen. There we go. All right, so we're going to compare direct side by side. First year principal, if I had that 30-year mortgage, to be $4,033. By the 5th year, it's $22, and so on and so on. 20 years, 25 years, 30 years. And I'm assuming that the price never went down. So we're assuming that it's at least worth what I paid for it at the end of 30 years. Okay? Now, if we compare that 20-pay life, first year, you're looking pretty smart. $4,033 and compared to $3,257. But by the 5th year, I think I'm beating you now. And I'm using guarantees. I don't need illustrative values. By the 10th year, I'm smoking you. By the 15th year, you don't even want to be in the same room with me. By the 20th year, whenever I'm done paying premiums and you're still going, I'm already worth more than you're going to hope to be. And by the 25th year, $343. By the 30th year, my guarantee is $384 to your $250, and that's assuming that you can maintain the $250. And you still get to pay to keep it. So in summary, my real estate, I paid $456,018 over 30 years. I had a $250 value and less appreciation did occur, and we also know it could have gone down as well. I've got continued insurance, I've got continued taxes, maintenance in order to keep it, and I've got continued liability exposure. On the flip side, with my little old 20-pay life, I only had $304,000 in cost over 20 years. My guaranteed value in 30 is $384, no further cost to keep it, and I've got guaranteed annual growth as long as I own it, with additional upside potential at no cost. So if you thought real estate was a grand thing, how are you feeling about whole life now? So the real question is, how much whole life can you buy, not whether you should do it or not. It all depends upon health, affordability, and cash flow, and not if it's a wise decision. Wouldn't you agree? Because, see, money may pay the premium for life insurance, but health is what buys it. Because none of us know when that magic moment is going to occur that we've just bought our last amount of life insurance. I've yet to have one widow or widower or business owner that when death occurred had too much. I don't know of one check that's ever been sent back to an insurance company because there was too much. But if you found out you had terminal cancer today, and I would ask you, if I can get it for you, how much life insurance you want to buy, I think we have a little different conversation. See, in America, we often have reverse priorities, right? And this is a little worksheet that you can use. Look at your car insurance. Take the value of your car. Look at the premium that you pay for the collision and comp, because if you're a mandatory auto insurance, you have to have liability. You don't have to have collision and comp. So let's be fair and let's look at what you're paying to insure the car. Now take that premium as a percentage of the value of the car. Okay? And 5 years from now, how much is your car going to increase in value? Okay, then how much is the insurance premium going to go down? It doesn't sound like a good thing, does it? All right, let's look at our home, see if that's a better deal. All right, now, how much does it cost me to insure my home? Take a number. And take that as a value. Now, how many people do all of you know? Just think of all the people you know. What percentage of the people that you know have ever had their home blow away or burned down as a percentage? I mean, in the event of a catastrophe like with Katrina or something like that, if you're in that area, that number may be a little larger. But by the same token, the majority of the people, most of us, don't have total losses on our homes. Is that fair? And if we look at what we're actually going to collect in comparison to what we pay, or the risk that we can, even in a total loss, compared to what we pay, is what I'm talking about. All right, now take on the other hand, how much money you're bringing into the household. See, one question I will ask a client at this point is, would you be willing to give me all your future paychecks for the amount of life insurance and assets you currently own? Think about it a minute. Would you be willing to give me all your future assets for the amount of life insurance and assets you currently own? How many of you would? Better raise your hands. Because if not, you got your first sale when you go home. Right? Because are you aware that's what you're asking your family to do? See, we understand numbers better than we think we are. We've just got to learn how to get out of the way. So again, if you make $50,000 a year, and you're going to work another 20 years, 50,000 times 20 is $1 million. How many people making $50,000 a year have $1 million worth of insurance? And how happy would you be if you don't get a raise over the next 20 years? Right? So I can downplay it and make it more real. Now, what if I made $100,000? Keep it simple. Because people don't care what you know until they know you care. This is a relationship business. We've got to find out what people are concerned about, what they care about, and talk to them on their level. Once I find out what's important to you, we can now have a meaningful conversation. Same thing with income. Especially with business owners, one of my favorite questions is, when's the last time you took a 6-month vacation? And when they get done laughing, I say, well, what would happen if you did? Often, I wouldn't have a place to come back to. Well, what happened if you never came back? What would that do for your family, for your employees, for your business? On a personal basis, who's going to pay your bills if you can't? Sometimes it's mom and dad. How long is mom and dad going to be able to do that? So again, if we think of really what the value is, and if you look at the premium you pay for life insurance or the premium you pay for disability insurance as a percentage of value, I would suggest that most of the clients you're going to talk to are paying a lower percentage on the things that matter most than on the things that don't matter as much. So let's take a look then at leverage, because here's where the magic actually really starts. How many people in here will probably buy another car? How many of your clients are going to buy more than one car over their lifetime? And what's the normal way we buy cars? Either we write a check or we put it on payments, right? I don't know of any other way. Right? No, that's not buying it. A lease isn't buying it. I said buy it. It's going to be mine for better and for worse. So let's say I'm going to buy a car. Well, let's use again a lower value. Let's say I'm going to buy a modest $40,000 car. 48-month loan. As of 10/12/2012, Chase was the lowest rate on the internet at 3.28, still about the same, so I didn't see any sense in really changing the slide. So as of the monthly payment then would be $890.33 a month. Total cost would be $42,735. Now that's if I financed it, right? So I actually paid $2,700 more than what the purchase price was, and at the end of 48 months, how much more is the car worth? And when I get ready to replace that car next time, is the new car going to cost more or less? So if I did nothing but make my car payment, how much further down the path am I to buy the new car? Or am I going to probably have higher payments? And then higher payments. And higher payments. Now the other way to buy the car would be what? If I wrote a check. Well, if I wrote a check, that means I'm a saver, right? Now if you wrote that $40,000 check, how much money does that money now make after you write the check? Really? Well, if I wrote the check from any source, if I had stock and I sold the stock, how much is that stock going to make? That's what I thought. If I had a checking account and I wrote the check, I cashed in a CD, anything I'm spending the money, non-leverage, I'm talking about spending it, it's gone, right? Okay. If I had a used car, let's say it's $20,000, 48-month loan, again, rate was still fairly similar, 441 or 445, cost with interest 21,839. Now, if I could show you a way to buy those cars with a little advanced planning and make money instead of lose money, would that be better than what you're currently doing? Fair enough? Now remember, anytime we're creating a solution, it normally isn't instantaneous, right? I mean, it's like the farmer who did the analysis of his farming operation, and after careful analysis, he determined that harvesting is where he made his money. So he decided, to heck with planting and cultivating and fertilizing and all that, all I'm going to do is harvest. He wasn't a farmer very long. But aren't we much the same? So let's take a look. If I use my money instead of the bank's, let's say I take a male 45, select preferred non-tobacco, and I bought a 10-pay whole life. I'm going to shorten the period of time without creating a modified endowment where I've got a money market on steroids. Premium's $500 a month, so we're just right around that same price we were talking, right? The only difference is at the end of 10 years, how much money do I now pay? And is it still going to grow? That's what I thought. Just checking. Make sure I'm on track. $142,398 initial death benefit. So if I get killed, can my family still buy cars in the future better than they're doing them now? Yes. I dare say that the bank probably wouldn't give an extra $100,000 to my spouse just because I died after making my first payment and pay off the loan, right? Okay, and in addition to that, now am ready to harvest because now I've cultivated and I've fertilized after the planting, and now I can harvest for the rest of my life because there's no further cost. So in 10 years, I'm going to buy my first car with my own money my way, and I'm going to pay back at the same rate that I would of the bank. So on a 10-pay basis at the end of 10 years, I've got a guaranteed cash value of $58,395, which means on a guaranteed basis, I would have had a cost to be insured for that $142,000 of $1,600 for 10 years. That's $160 a year, which is not too much for insurance, right? Fair enough? But on an illustrative basis, I would have made $1,500. So now at the end of 10 years is when I'm going to buy that car. So let's take it off the guarantee. I don't care where we take it from. Guarantee, illustrative, either way it's going to work. So I'm going to take $40,000 to buy that new car, okay? Let's say I've got a 4% interest rate. Let's make it worse. I can get it at a bank for 3.3, but I'm going to get it from the insurance company at 4. So at 4% of $40,000 is how much? $1,600, right? See what calculators have done to us. So $1,600 over 4 years would be how much? $6,400, right? So let's say now I'm going to buy my next car in 5 years. What happened here? This grew from 58 to 67. About $9,000 on a guarantee, about $22,000 here. Would you have given me $6,000 if I give you 20? How many times do you want to trade? Is that a better deal than the way you're buying your car now? Well, let's look and see what happens now. Now, at the end of 15 years, I know the car is going to cost money. Well, guess what? I've got more. You know what? I don't notice fewer cars out on the highway because gas is $4 a gallon than when I remember back in the old gas wars downstate when it was 19 cents a gallon. Because it doesn't matter what a gallon of gas costs, it's can I buy it? So here, I've got an automatic increase. I'm at least $9,000 better off and more prepared to buy the next car than I would have the old way I'd been buying the car. Fair enough? And every 5 years, it gets better and better and better. And I'm showing a worst-case scenario where I didn't pay any interest at all until I paid the whole thing off, which made it even worse. See, if we can make things look worse than they're likely to be, and it's still better, I have fewer arguments. Fair enough? Now, you can use this same concept with college planning. How are 529 plans doing? Not doing real well, are they? Well, now, when you spend that 529 plan, let's be positive, and let's say, now, when your child's ready to go to college, the 529 plan is above water, so tax-free might actually mean something. Now, first of all, your child has to go to college. So if your college graduate became a juvenile delinquent instead, now you've boxed yourself in a little, right? Or what happens if your college graduate got a full ride and you didn't have to use it for education? That's a good problem, but now I've got a tax issue. Well, if I could show you a way to either fully or partially fund your child's education and get part of your money back, would that be the way you'd like? Because how much of the 529 money do you get back after you spend it? That's what I thought. Concept-wise, doesn't it still work the same way? At the end of 10 years on this, I could take out, I've got $61,000, I could take out $15,000 a year for 4 years. What's going to happen? Guarantee is still going to grow from 58 to 87 no matter what. So now that I took the money out and I still put it back, it's still going to continue to grow. Because if I don't pay the interest, what happens? It's still going to just be added onto the loan. Again, as long as I don't get greedy, because again, pigs get fat and hogs get sloppy, slaughtered. Interest expense of $2,700 is the new auto. And then I start over, whereas with my insurance policy loan, interest roughly the same. And I've got a guaranteed gain of $9,300 after 5 years. That's from the 10th to 15th year. Illustrative gain of $21,000. I think that's better than the system you're buying for your cars. And oh, by the way, if the 529 plan is still underwater and I'm using this as an alternative for there, then guess what? I can use this instead of the 529 plan, give it another year to see if the market's going to come back and cooperate. I can turn it on and turn it off. And oh, by the way, if I'm now concerned, now that I no longer have this expense for college and I'm thinking about me in retirement, what's the limitation on how much money that I can pay back? Oh, no, I could put it all back and now it's just for me. And there's no IRS problem. And as long as we preserve our treatment, because NAIFA is going to continue to increase and we're going to have more troops to help fight our cause, we'll keep that tax treatment. And every 5 years just does nothing but get better. So the future challenges that we know with an auto purchase is the price of the car is probably going to go up. Interest rates may increase. Auto value is probably going to decrease. Come on. The advantages of using the life insurance policy loans, on the other hand, I've got a competitive interest rate for the loans because typically a life insurance policy loan is at least somewhat comparable to a normal market rate. The contract values is going to grow every year to help offset the increasing cost of the purchase. And payments are totally flexible in the repayment. See, if I'm using my own money and I run into a bad patch of road and I can't pay the premium or I can't pay the payment back for 2 or 3 months, anybody going to come and get me? No, because the value is still growing. How many payments are you going to skip on the car before somebody comes in the middle of the night? And they usually are 610. The loans of outstanding at the time of death are totally paid off. So we also heal ourselves as well. That's the miracle of life insurance. So it's always better to use other people's money, especially when it's really yours. See, we all know, any of us that are parents already know that. My son taught me that. When he's using his money, he looks at it altogether different than when he was using mine. Right? So we know it's better to use other people's money. But why not use other people's money to where it's really ours to begin with? And since it's ours to begin with, we have control. And it can even heal itself when we make a bad mistake. If I am putting together a nice diversified portfolio, and I've done all the proper risk tolerance strategies and everything else, does my crystal ball know what's going to happen tomorrow? Or next year or 5 years from now? But if I've got at least one asset class sitting on the sideline that's guaranteed to grow every year I own it, with additional upside potential, can't that help make up for some of the other bad decisions that I may have made, even though they appeared to be good decisions at the time? So the bank can always say no to your loan. But when you're in control of your planning, the insurance company won't. Because again, we're the original promise keepers. Ask and you shall receive. Questions? I think we're pretty well on time. Yes, ma'am. I think they're going to be on the site. In fact, most of this was on the NAIFA Client Cast in February, so the whole presentation is in the archives on the NAIFA.org. But go to the Client Cast, not the webcast, because the webcast is only the audio, but the Client Cast shows the majority of that. Yes? Was it just the opposite? Okay. Well, Jay knows. My dyslexia shows sometimes, so. So it's the webcast? Okay, the webinar power session is what it's called for the power, and the other one is just the audio. Yes.
Daniel from Montana. I'm assuming that as you were calculating the mortgage expenses and so forth, you weren't even including insurance.
No, that's principal and interest only. Right.
And it occurred to me as you're talking too that we're not taxed on the little bit of equity we have. We're taxed on the whole piece of the property, even though we only own a tiny little bit of it.
Exactly. And see, like I say, I don't even make it as bad as it could be on the other side. I make it the worst on me, because if I make me look as bad as I can look and I still look better than you, we're not going to have as much of an argument. Yeah. All right. Talk about, the question was, can you talk about opportunity costs for a minute? Well, the issue is, do we know whether renting is better than buying real estate? Do we? We don't really, because, I could buy real estate and it go in the tank, and all of a sudden, owning wasn't as good as renting. The question is really more of a security, and when I'm comparing opportunity cost, accessibility is where we really win. Because, see, the accessibility factor to whole life is really more than just pure rate of return. If I'm looking at internal rate of return, and I'm using buying term and invest the difference, in any hypothetical situation, we can always say, well, yeah, that'll work. We used to say in the investment world that there's never been a 10-year period of time that the market lost money, right? And I could defend that, and I could prove that until 2009. And we gave away 10 years of gains in 1 year. Will I gain it back? My crystal ball can't answer that. See, the question that I would ask at that point is, would you rather have the opportunity to be rich or the guarantee you'll never be poor? Because at the end of the day, that's really where it is. Because, see, if I build the foundation, because, see, this is foundational planning to me. See, if you're looking at building a house, what's the most important part of the house? And how many people do you have walk up and say, oh, that's a nice looking foundation? I've never had one person compliment me on the foundation, but by golly, if you cut corners on that foundation, no matter how nice the structure is that you put up above it, if the wind blows too hard or the earth moves too much, you're in trouble. Right? I mean, we wouldn't have to worry about nuclear reactors going bad if it was just that easy, would it? That's a lot stronger foundation than almost anything else, and we've still had problems with them. So if I've got at least one thing that I can sink my teeth into and I know it's going to be worth more every year, when my cost of acquisition are gone, I can leverage that and I can take advantage when the market's on sale. Because guess what? Does the insurance company ever ask what you're going to use the money for when you ask for a loan? No, because it's your money. Well, see, there's an old saying in the investment world that when they're yelling, I'm selling, and when they're crying, I'm buying. That's the contrarian approach. So once I've got money, I find it's a lot easier to have money. Because now, guess what? When the bargains come along, here we go. I'll usually ask my clients, well, what, especially if I've got a female client that comes in dressed nice and all this and that, and the other, say, what's your favorite department store? What's your favorite department store? Macy's, all right? Now, if you got a sale bill from Macy's and they said, for the next 9 months, everything in the store is 50% off, would you toss it in the garbage and say, boy, I'm going to wait till that's over? Doesn't even sound reasonable, does it? But is that not what we do when the market goes down? And why do we do that? Because we had all our chickens in one basket. See, this helps you insure the goose and the golden eggs at the same time. If the goose quits laying, I've still got the eggs. If all I've got is the goose and thinks the goose is always going to produce, the goose may get tired. So from an opportunity cost standpoint, it's really diversification. Because if you think of whole life as an asset class, it's a very low correlation to most other assets that you can think of. Because how many other things can you tell me that has tax deferral, that's guaranteed to increase in value every year you own it, that has 90% accessibility upon request? Just that alone. Right? So because of the low correlation of assets, that's what makes it so valuable. It can be whatever we design it to be. That's the magic of whole life. Other questions? Yes, sir.
I noticed in your discussion you do not pay comments about universal life insurance back in the early 80s.
Right.
Arbitrage occurs with high interest rates.
Right.
Down on a life basis.
Right.
Your thoughts about whether that was good or bad or where we're going since then?
I think everything has a place if it's used in the right place for the right reason. If I did a survey of the average American male and I discerned that the average was a size 10D, and most of them like brown loafers, and I opened up a shoe store and that's all I had, probably wouldn't be real successful. So universal life, even in today's marketplace, I'm not saying there aren't places that it fits. What I'm talking about here is as an asset class, because universal life is buying term and investing the difference in a tax-deferred environment. The problem is the cost of doing business keeps going up. And the way I explain universal life, unless it's a secondary guarantee, and the problem with the secondary guarantee is it's worth less every year I own it, because it's a guaranteed level death benefit. So if you tell me when you're going to die, I can tell you what the right product is, but if you won't commit, I can't either. And at the end of the day, universal life's flexibility can be good or flexibility can be destructive. But universal life, standard universal life, whether it's variable or standard, whatever, it doesn't matter. Universal life is like a pet. If you feed it real well, it gets fat. If you starve it, it dies.
I hear them say, unfortunately, the companies have bailed out.
Well, many have, but not all have. Yeah, not all have. There's some that are still growing quite a lot. Yeah. And in a low interest rate environment, when a volatile market, that's sometimes where a mutual is going to outshine a stock company. In a high interest rate environment, it's going to be just the reverse. So if you can tell me what the future holds, then I'll tell you what's going to perform the best. I'm not that good. Yeah.
Nobody lost money in whole life policy.
No. Like I said, a lot of people don't realize they have an allergy to red ink until they see it on their statement. And when every other envelope you opened up, it's bad news, and you open up that one and it's good news, I got a lot of phone calls that say, why didn't you talk me into buying more of that? Well, first of all, I don't talk anybody into anything. I put price tags on options and help you make educated decisions. Because I want you to have responsibility for your situation. Because with all due respect, I don't have to live with your situation, you do. All I am is to help. At what age does it not work? At the age it's no longer able to be issued. Because with a mutual company, unless it's a really high rating, we just had a case issued, Table J, with a $250 per thousand extra rate, and it still worked. Yeah. Well, it was a little shaky, but you just have to hold the pen and the writing does itself, Any other questions? I know we're pretty well out of time here. If not, thank you very much.